Okay, we still have a few folks coming into the room right now, but let's get going here. Hello, everybody. Good afternoon, and welcome to this special webinar event. My name is AJ Bory. I'm the Chief Marketing Officer here at Totum by Tiffin, and we're excited to have everybody join us here today. The conversation today will be presented by Larry Shumbres, co-founder and Chief Revenue Officer of Totum, and Karlan Patel, a model strategist at State Street. Karlan and Larry will be taking us through an overview of State Street's models and ways advisors can streamline their practice with the powerful combination of these model portfolios and Totum's risk profiling platform. As a quick note, we'll have a Q&A box that you can find at the bottom footer of your screen. Please feel free to ask questions along the way. And in addition, we'll have a dedicated question and answer section at the end of the webinar. So with that, I would like to hand over the presentation to Karlan to begin. Karlan?
Thanks, AJ. AJ, could you please give me a thumbs up when you see my screen here?
Yep, we see it.
Perfect. Well, hi, everyone. My name is Karlan Patel. I'm a model strategist at State Street Global Advisors. I'm very excited to be here today to talk about ETF models. I think all of us have seen the data that advisors spend on average 17% of their time on portfolio management. We've all learned that in recent years that third-party models are an effective solution to help advisors get time back to focus on what matters most. So I was in Morningstar the other day, and I saw that there were over 2,200 different model portfolios in their universe. So I got thinking, with all of those thousands of models to pick from, I think it's important now more than ever to find partners in this space that provide enduring value. And that's really what I hope to go through today. And there's really three key tenets that I think make our models unique. The first is the partnership, which I'll go through in just a moment. And that is, the people managing the strategy. The second is a partnership that we form with clients. And the third is the product itself. And I'll start with the people. And I feel it's always best to zoom all the way out and first to talk about State Street as a whole. I'm going to go and advance to the next slide. State Street Corporation. So we were founded in 1792. We're one of the world's largest and oldest custody banks in the world. And on any given day, we touch about 10% of the world's assets. So with that comes global reach and really a breadth of capabilities. And I'm going to zoom in on the green box on the right-hand side here, the asset management arm of State Street, which is State Street Global Advisors. And on the next page, we'll see that our firm is just shy of $4 trillion in AUM. That makes us the fourth largest asset manager, and we have thousands of institutional intermediary clients across the world. So because of that, we're spread across 10 different investment centers, and that really grants us 24-hour trading capability. On the next page, we'll see that we are a leading partner as it pertains to pensions, endowments, foundations, sovereign wealth funds. I'd like to focus your attention on the third column number 3. So we have really a heritage in the ETF space. We're founders of the world's first ETF, SPY, in 1993. And also today, we have more than 150 different ETFs that span the global universe. On the next page, I'm going to start talking about, so with this idea of zooming in, talking about the team that is managing these model portfolios, and that's the Investment Solutions Group, ISG for short. There's a lot of names here, but I'd like to focus your attention on the bottom part of the page. This team is made up of about 45 folks spread across 9 different investment centers, and they have an average of 17 years of average investment industry experience. In the bottom left-hand side, we'll see that there's a few other teams as well that support them, and this really creates a very effective network of resources that they tap into when they're thinking about trades. We see that they have just shy of 250 billion in AUM. And like I mentioned, they really have a heritage in managing institutional money. So quite a few capabilities. What I'm going to focus on is ETF model portfolios. And that's really, we have 2 suites that I'm going to talk to you about today, our strategic models as well as our active models. But before I do that, I want to take a step back and remind you of those 3 pillars that I mentioned earlier. I talked about the people. The second was the partnership. So not only do we have a dedicated distribution team for model portfolios, but we also have a dedicated team for operations as well as research and strategy, myself included. And so we're really big on offering you all the resources you need to be successful with your firm. But the other part of it is this, is the collateral. All of the collateral that we produce from the portfolio management team to the end client is made with the retail client in mind. So there's no heavy investment jargon. And what that does is that creates seamless information transfer from the PM team to the client without anyone along that process having to play that game of telephone and deciphering that heavy investment jargon. But let's start with the strategic asset allocation. I always like to answer that question, why should I care about strategic? And really, we're getting that multi-dimensional team that I mentioned, ISG, who's been managing institutional money for over 40 years. But the strategic model for 7 to 9 basis points is globally diversified, includes 15 ETFs, and really forms our best thinking for our tactical models. Let's take a look at the process at a high level. We start with our capital markets model. Here, we're taking a couple things. We're looking at expected returns, expected risk, as well as correlations. And we're going to take these three in tandem and put them in an optimizer that's then going to pick the most optimal portfolios. Those portfolios then finally go through a fundamental review where we inject in any qualitative insight. And lastly is the implementation. And so here, up until now, we've talked about asset classes. We've been product agnostic. And so what we want to do in step 4 is actually fill the portfolio with the best-in-class ETFs. Sometimes, most of the time, that happens to be spider ETFs. But on occasion, we will use third-party ETFs if we feel like it's the best solution. Now, the question I always have whenever I look at a process is, if the entire process is hinged on step 1, in our case, the forecasts, how is our team coming up with those forecasts? And this is a bit of an academic exercise. You can see that our team, ISG, they start with labor, capital productivity, they add in inflation, earnings growth, dividend yield. As I said, this is academic, which is why they rely on our team of PhD economists to do this. And we do this for over 125 different asset classes. I actually put all of them here, some of them here, in fact, on this page. And this is not to test your eyesight, but rather just show you the sheer breadth of this capital markets model. We're looking at the short term, intermediate term, and the long term, and not just looking at returns, but risk as well. And what we're doing is we're going to take those 3 ingredients that I mentioned before, the returns, the risk, as well as the cross-asset correlations, and those are going to go together and form an efficient frontier, which is this line that you see here on the page. We then pick the 6 most optimal portfolios that range in equity allocation from 20% equity in the bottom left, all the way up to 98% equity. Then the process doesn't stop there. And I think this is the most important part of the process. Here we're checking for reasonability, suitability. We want to make sure that the portfolio is within the guardrails that we have in place. And then also inject in any qualitative insight from around the world, anything related to monetary fiscal policy, anything that the quant models don't capture. And next in the process, we're big here at SSGA on a very strict risk management protocol. And so I'd like to say what we're doing here is we're looking both through the windshield and the rearview mirror to make sure, 1, have these portfolios done what they were intended to do, but then 2, what do these portfolios look like going forward? And here's where we do the stress testing. We recreate events like the GFC, the taper tantrum, as well as the COVID drawdown to see how these portfolios would fare. And we also have monthly monitoring of these strategic models as well. Now, typically I show the fact sheet here. As I go through active, I think the best place is to show you both of the fact sheets at the end. So I'll go through that in just a moment. But as I start to set the stage for active, again, let's come back to that question, that central question of why should we care? Or why is it different? And really, the active models here, these trade once every 2 weeks, potentially, about 12 to 20 times per year. And these form our best thinking, both short, intermediate, and long term. We're going to use that same team, ISG, with their multidimensional team, collective intelligence. And we also have that process where we're marrying the quantitative with the qualitative. But I think the 2 most important points here are these bottom points, the track record. The active models have been around for 13 years, which is unique in our industry. And they also have a very risk-aware part of the process. What I mean by that is we are always gauging how investors are getting greedy or complacent and we use that to influence the asset allocation. I'll go through that in just a moment, but let's take a step back and talk about the philosophy as well as the process. This is the most important question as it pertains to tactical asset allocation, the philosophy. What is the team thinking? What are those opportunities that they're chasing? And the idea here is that ISG believes that in the long run, capital markets are efficient. But in the short term, deviations exist, and that's because of behavioral biases and market frictions. And so you might ask, well, what are those opportunities? And we really see two types. We see the broad asset class ones. So here is equities a more favorable place to be in versus, let's say, commodities over the next month. But then also intra-asset class. Is Pacific equity more favorable than European equity over the next month? And it all starts with this process here where we evaluate the macro environment. We have a proprietary indicator that measures the risk sentiment, as I mentioned, which I'll go through in just a bit. Step two is to then use our factor models and to gather more quantitative indicators as well as qualitative insight. And step three is the construction as well. Let's start with step one, the MRI, the market regime indicator. Imagine taking the VIX, the volatility index, which is a forward-looking indicator of volatility. Imagine taking it and stretching it so that it not just covers US equity, but also international equity, but then also stretching it vertically as well so that it not just covers equity, but risky debt and currencies. That's what the MRI aims to do. And it classifies the market into one of five regimes, ranging from euphoria all the way up to crisis. So crisis is, I think of Q4 2018, I think of the COVID drawdown. That's when investors are very fearful. Euphoria is when investors think that the markets are going to be very rosy in the near term. And what's interesting about our team, and this is a key point, is that when we're in euphoria, even though indicators are optimistic, we actually get a little bit contrarian because we know that investors are getting a little bit too greedy or becoming complacent, in other words. And so we take some risk off the table by allocating more to fixed income as opposed to equity. We've been watching the MRI and refining it for over 20 years. And you can see here, it's captured many of the market events. We have the GFC, the taper tantrum of 2013, Q4 2018, as I mentioned, and more. And so this is key. We've been doing this for 20 years, and it's been refined and evolved throughout the years. Now, I want to take a bit of a step back because I know this process can seem a little bit complicated. I mentioned those two opportunities, the broad asset class ones, we call those the directional, as well as the relative value opportunities, or in other words, the intra-asset class opportunities. So we use the MRI to exploit the directional, as well as our capital markets model and any qualitative insight that we get from the ground up. And remember, this is coming from our 9 investment centers across the world. Now, for the relative value, we use factors, and I'm going to go through that in just a second here. We have something called the global equity model, and this really gauges factors in the universe. Look at both top-down and bottom-up factors. So top-down would be macro, bottom-up would be some of these other names that you see here, value, quality, sentiment, momentum. An example of what some of these are, I think the names indicate what they are, but sentiment is often confusing. Sentiment here is, if you think about all the analysts on Wall Street who are coming up with earnings estimates and revenue estimates for the S&P 500 companies, they are revising those estimates intra-quarter all the time. And if we see more positive revisions than negative ones, we see that as a bullish indicator. That's just one example of one factor that we'd use to exploit those intra-asset class opportunities. Now, we also did the same thing on the fixed income side, but for the purposes of time, I just want to take that step back and look at the process overall. We've talked about how we use the MRI, we use quantitative indicators, qualitative insight. Let's talk about what the team does with that. It starts with, on the left-hand side, every day they're collecting this data, whether it be quantitative or qualitative, and they're elevating that and talking about it within their teams. But what I like to focus on is this third column here, the alpha meetings. Every 2 weeks, every person in ISG meets globally to discuss any trades that we come up with for our portfolios. And the key is the second bullet here, the devil's advocate. So we've all been in the industry for, I assume, a few years at least. And we know that when the guy or gal with the most experience or the most tenure in the room speaks up, people tend to side with his or her opinion. That's called groupthink or social proof bias, for formal terms. And so we're very cognizant of that here at SSGA, and we want to combat that directly by having a team called the devil's advocate, and they change every time we meet, the constituents change, that always challenge the other side of the table to make sure we're always hearing the opinions on both sides of the table. And I think that's a very key part of our process that makes us unique. And finally, as I mentioned, up until now, we've talked about asset classes. We then implement the portfolio by picking the best in class ETFs. At this point, I'm actually going to stop screen sharing here so I can show you what the models look like themselves. I'm going to shift here to the active asset allocation fact sheet. You can see that we have 6 portfolios ranging in equity allocation from 20% to 98%. Now, again, as I mentioned, to exploit those directional opportunities, they may change. They may be, you can see the moderate model is 67.5% equity right now, and these change about once every 2 weeks. And we have quite a few tickers here. We also employ the use of third-party ETFs. You can see Invesco has a commodity ETF that we're utilizing here in the real asset sleeve. And we also have a few active ETFs in the portfolio as well. XLSR, Pfizer. These are looking at the respective asset classes, so equity or fixed income, and picking the best and most favorable sectors for the near term. All of this for 22 to 27 basis points. On the next page, we see performance. Remember, these portfolios have been around for almost 13 years. We can see since inception, they have all outperformed their benchmarks. The moderate, as an example specifically, has outperformed its benchmark by about 100 basis points. Now with the strategic fact sheet, and I'll work with AJ to make sure that all of you get a copy of these fact sheets after the fact, but we can see the same thing here. These ETFs, you're getting 15 ETFs in a strategic model, all for 7 to 9 basis points. And you have lots of nuanced asset class exposure. So international small cap, tips, senior loans. This gets much more in-depth, nuanced than a traditional strategic model, which is another reason I think it makes this unique. And same story with the performance. We are outperforming over longer time periods. I'm going to pause there. I'm happy to take questions at the end or throughout. I'm going to go and hand it back to AJ and Larry. Larry's going to go through the platform itself and go through that in depth. Thanks, everyone.
Great. Thank you, Karlan. Hi, this is Larry Shumbres. I'm the co-founder and chief revenue officer for Totum by Tiffin. If you're not familiar with Tiffin, Tiffin is our holding company. And what we set out to do here at Tiffin is really reduce the frictions by building first-class category fintech solutions powered by data science, AI, and machine learning. Under the Tiffin umbrella, we have 12 companies. Out of those 12 companies, the top 8 here are wholly owned by Tiffin. And Totum, of course, is one of those companies that was acquired at the end of last year and just helps Totum really enhance the product, enhance the machine learning, data science, and the usability of the tool for financial advisors, and also help reduce the risk for clients out there in the industry. So today I really want to focus more on how we could leverage and utilize the State Street models within the Totum platform to help win more business when you're working with prospects, and also make recommendations using those State Street models when you're working with clients to better leverage and better assist those advisors or clients by reducing the risk in their portfolios. So today, when you log in as an advisor, you'll see that there's 2 workflows. And the unique difference between Totum's risk platform and other platforms in the industry is the fact that we're really focused more on risk, right? We are using data science and machine learning on the back end and always assessing the risk in the portfolio, as well as on the front end in the risk tolerance questionnaire, to better assess that overall risk for the client and make more suitable recommendations for you as the advisor. The 2 workflows that we have here that we found that advisors use most when it comes to risk tools are growing their business, working with prospects and converting them to clients, and then checking that compliance box, working with their existing clients, making recommendations and checking the compliance, whether it's with the FINRA suitability 2111 rule or with the SEC's best interest rule, section 2 and section 5. To work with prospects, it's really simple. Add their first name and last name and email address, or you could upload a file or connect to some of these CRM databases in the industry. Once we add our prospects here, we could go through the workflow by householding those prospects, sending out the questionnaire. And when we send out the questionnaire, we have the option to send it directly via email, copy the link, or take the questionnaire with the client. And we have the mobile or the full version of that questionnaire. Once the questionnaire is sent out, you'll see the status that's pending. And down below, if you look at Lost Summers, this prospect has already completed the questionnaire. So for your records, we'll timestamp and archive all the questionnaires, whether they're complete or incomplete. From here, you can review those questionnaires, as well as download a quick report. If you have any clients that are not tech savvy, you download a blank questionnaire here and upload the information later. You can see we ask really simple, unique questions and relatable questions on the front end, like age and income, number of people in the household, dependents, zip code where they live. We're really focused more on the human capital factors within the risk questionnaire than whether the markets are up, down, sideways, or in between. And what we're really focusing on is that risk capacity outcome more so than risk preferences. We do score both, but the whole idea is to have the risk preference and risk capacity separate than one number to work with. Once the questionnaire is completed, you'll see it's timestamped and archived here. You could also resend the questionnaire again at any other time. And we also notify you after 12 months if the questionnaire has not been completed or updated. From here, I would either have the option with the prospect to add their portfolio or propose a model. You can see down below with Lost Summers, we already uploaded his portfolio. So to upload a portfolio, we could start from scratch and manually enter the portfolio, upload an Excel file, or again, select from one of the models. If I want to propose a model, I'll see that the risk preference is a 13 and the risk capacity is a 31, and their current portfolio is a 64. So I may want to recommend something in between the 13 and 31 inside those guardrails. So I've already selected the State Street Global Advisors Fund here. So I can select this model marketplace, select State Street, and from here, I could add any of those models from State Street that are within that risk band. So we'll stick with this 30. From here, once I'm satisfied with the proposal or recommendation, I could then turn to the proposal and run some custom reports for that meeting. We'll automatically take that State Street model and add it to this investment policy statement over here on the left. We could add 2 or 3, up to 3 State Street models to make recommendations for this prospect. And we could show all accounts, separate accounts, or also group those accounts into a separate portfolio. So if I want to recommend from Shay's IRA, I selected that State Street model. Again, I can select from my model marketplace, other State Street models in here as well. So if I want to be a little bit more aggressive, I could select the 34. And if I want to be less aggressive, I could select maybe the 19. And then over here on the left-hand side, these are all the pages within the report. So I could turn on or off what I'd like to show in that report. I could also select the time frame for historical simulation or return simulation. And again, I also have the option to turn that off. Everything's white labeled in here with your contact information, your logo, as well as your client or prospect's name. Then you can preview the document here on the right-hand side. And once you're satisfied, you can export this to PDF. So here within the report, you'll show Shay's current IRA. That's a little bit more aggressive at a 39, and the State Street Global Advisors active moderate conservative strategy here on the right, that's a 19. Again, you could also select up to 3 different models, look at the individual holdings, an expected gain loss over a 12-month period, as well as the expense ratios. This 39, I believe, might just be the SPY or an index. As I mentioned, we selected up to 3 different models here.
Hey, Larry, before we continue on, there's a couple questions coming in here. One of them is asking, how are you coming up with the risk stats for the model portfolios? And is it based on capacity or some type of VAR or other measure?
Right, great question. So the overall portfolio you'll see here is a 64. So that's pretty aggressive for a model. Usually you'll see on a scale of 1 to 99, you'll think that anything above maybe an 80 would be super aggressive, but really using VAR instead of just standard deviation is really one of the unique factors that helps us score these individual securities and overall portfolios. For instance, if you just use standard deviation to score an overall portfolio, that's great. You could get to about 95% probability if you're using plus or minus 2 standard deviations. But at the end of the day, you're then making up your own scale of 1 to 10 or 1 to 100 to plot that portfolio on the scale. So for instance, a 60-40 portfolio using just standard deviation, most likely it'll be right around a 60, correct? But really there's no scientific reasoning behind that. So with using VAR or value at risk, we're able to calculate the portfolio risk score at a 99% probability, confidence probability. And what we're saying here is this portfolio, this 64, has more meaning to it. It's telling us that there's a 1% chance that this portfolio could lose more than 64% over the next 12 months. So a big difference compared to just using some standard deviation. And the biggest benefit here is really showing 2 risk metrics, the risk preference and capacity separately. Risk preferences showing your willingness, and risk capacity showing your ability to take risk. Whereas a lot of other risk platforms and questionnaires either have one outcome that puts you in a conservative to aggressive bucket, or they just have one number that is hard to just work with. So really using that capacity in those guardrails with preferences and capacity helps the advisor have a better conversation, and it's also more compliant and is tied to the rules and regulations of the SEC and FINRA.
Great, thanks, Larry. There's another question that came in. I just want to ask the attendee. It says, notice cost difference. Can you please clarify? Do you mind just replying again? Is that in regards to Totum or the State Street models? And we'll make sure we get back to your question.
So I can briefly, just Totum cost overall is $99 per month per user. So great return on investment, add 1 new prospect, retain your clients over time, and it will easily pay for itself. SEC attorney that we worked with while we were building Totum quoted saying that Totum is really the least expensive insurance policy for a financial advisor. There's no more questions right now. I just want to touch on the model marketplace real quick. Again, here under the settings and model marketplace, this is where I could select State Street. And as I scroll through here, I could select what models I want to show within for the prospect and make recommendations or add to that portfolio for a client. So for instance, if I go into my check compliance, and I hit check compliance here, I could see what clients need some adjustments. So if I go into Jen Banks and I see her overall portfolio and she has 1 individual account, I could then compare side by side the model that from State Street that I would like to recommend and review with my client, and then also export that information to a report. So I went a little bit outside the risk band, a little bit more aggressive. But again, if I felt comfortable with this, I could finalize that and it'll create a trade blotter showing the buys and sells and how to move into that State Street model, as well as generate that proposal.
Great. So we want to open it up to the attendees right now. If you guys have any additional questions for Larry or Karlan, please make sure that you use the Q&A capability at the bottom of your screen. Larry, we had one question come in. Have the Totum proposals been FINRA reviewed?
Yes, the Totum reports and proposals are FINRA reviewed, and we do have a letter on file that we could share with you.
And then we have one other question here asking, can you show how you compare an existing prospect to a State Street model?
Yes, we touched briefly on that. This is an actual client that you would have, again, an example where you could show and compare to a State Street model. You could do the same thing in the prospect workflow. So from here, you would select that State Street model and compare it side by side. So we're going a little bit more aggressive. Look at the 12-month potential gain loss. Expense ratios are lower. And then also you can look at the individual holdings and some historical charts and also expected returns. And all that could be exported to the proposal for the client and or prospect.
Okay.
AJ, the question that came in on the cost difference, assuming that applies to the State Street models, I can speak to that.
Yeah,
really,
it came in at the beginning of Larry's presentation, so I think it came in when you were wrapping up.
Okay, well, there's really two ways that I interpret that question is, why is there a cost difference between strategic and active? And the other part of it is, why is there a cost difference between the risk profiles within each strategy? And I'll answer the first by saying that strategic and active, remember, we're not tacking on any additional IM fee. And so the cost difference is because of the difference in the underlying average expense ratio. So the active models are using the Invesco product, which is a commodities futures product that has a high expense ratio, but as well as two active ETFs, the equity sector rotation and the fixed income sector rotation ETFs. Now, within each strategy, the reason why there's a difference in expense ratio is because, and this is kind of counterintuitive because you would typically think the more conservative models would have the lowest expense ratio. Well, with the more conservative models that are more fixed income heavy, of course, we're using SRLN, which is our senior loans ETF. We're a big believer in senior loans, both in the near term and in the long term. And that has a higher expense ratio, I believe about 70 basis points, which is why the conservative models are slightly higher in expense. Hopefully that answers, I think, the two variations of that question that I could imagine.
Great, thank you. Okay, let's check in the Q&A box. If there are no further questions, I think we are getting to the end of our session here. So I want to thank everybody for joining us here today. We hope you took some valuable learns away on how State Street's models and Totum can help your business. We've included the contact information here on the slide. So to get a hold of State Street, you can reach out to spidermodels@ssga.com. And to get a hold of the team at Totum, you can use contact@totumrisk.com. So we invite everyone to take a closer look at Totum and State Street. And feel free to visit totumrisk.com to schedule a personalized demo to see how we can help your business. So if there are no other questions at this time, thank you, and please enjoy the rest of your day. Thanks, Larry. Thanks, Karlan.
Thank you. Thank you, Karlan.
Everybody.